Now, have you ever seen two investments, and let's say they both offer you a 10% annual rate of return? So how do you know which one is the least risky of the two? And let's say you have two investments and one of them pays a lot more than the other. Does it necessarily mean that it's riskier? I mean, you've heard the saying, you need to take more risk to get a higher rate of return. So how do you actually measure this risk? And so that's what I'm going to talk about in this video. So let's get started. Now, optimally, you'd like to have a risk-reward ratio of a 1 to 3. So what that means to you is for every $1 you have at risk, you should expect to get $3 back. And that is the optimal scenario. And a good scenario is 1 to 2. So for every dollar at risk, you're going to get $2. So that's our risk-reward ratio. All right, so what we're going to do here is we're going to test the risk factor of my index trading system to see how risky it might be. So we're going to put in today's date, which is 8/30/2019, and we're going to go back 3 years. So we're going to take the most recent 3 years and see what's been going on. So I put in 8/30/2016 over here, and now we're going to submit it. And what this software will do, it'll give me let's say I started with a $1,000 portfolio. It's going to show me what the trades were that were given to subscribers, and it's going to go day by day, and you will be able to see how much risk is involved here. But to do this, we first need to calculate our return. So you can see that we have a 427.42% return over the last 3 years. So if we go to this website over here, which is moneychimp.com/calculator, discount rate calculator.htm. But anyway, here on this website, it'll show us the annual rate of return for that. So it will show us the annual rate of return. So we had a 427% return. So that would be 527 now, because we started with $100, and 3 years later with a 427% return, or 427.42 return. We'll cut that in, we'll get that all in, 42. So that's what our portfolio would be 3 years later. So we'll put a 3 and we'll calculate it. So our annual return is 74.07% per year for the last 3 years. That's what the index trading system has been giving its subscribers. Now, if we go back and look at our risk-reward ratio, the minimum we want is 1 to 2. So if we now know that we're going to get an expected 74% annual gain, then the most that we should risk for that is half of that, or 37%. So, for example, if you had $100 invested and you made 74%, you've made $74. So the most that you want to lose out of your 100 is $37. So 37%. So let's see, in those 3 years, how many times our portfolio lost that 37%. All right, and so to do that, we've got in here 8/30/2016 to 8/30/2019. That's for the last 3 years. I'm going to hit the submit so you know that this is a fresh data that you're getting right here. Again, we're starting with a $1,000 portfolio. So it's going to show you the drawdown here, and we want to, we don't want to lose more than 37%. We don't want to have to risk that much. So as you can see, we have new highs, and it's showing you what the drawdown from that last new high is over here. So we're looking for something that says minus 37% or greater. Okay, so we'll see if we ever had to, do worse than the risk to reward ratio. So we're still scrolling, still scrolling, making new highs. Again, we're going, more new highs. Now it's a drop of 19%, more new highs. We just keep going. Now here we go. We got a drop of 27%, and it's still going down. It's a new high again. So We keep moving, keep moving, keep moving, keep moving. 11. So you see, not one time in the 3 years did we ever have to risk $37 to get a 74% annual return. All right, so there you have it, the index trading system with a 74% annual gain. The most risk that you'd be willing to take for that gain should be 37% according to the risk-reward ratio. And as you just saw, after 3 years, day-by-day action, the most that we ever went down was 29%. So that is well within the 1-to-2 ratio, and this is a very much an acceptable risk and safe investment. So you're risking 29% to get 74% annual gain. Now, let's use this and compare the risk-reward ratio to one of America's most popular investments, the S&P 500 index. So there is an ETF that does the same as the S&P 500 index. It's called SPY. And let's face it, most investors cannot even beat the market. So a smart move, and what many, many investors do, is they buy the index fund SPY and just buy and hold it. And they should get the same return as the S&P. Now, let's find out if these people are making a smart move. So now the S&P over the last 3 years has risen 34.48%. So if we had started with $100, 3 years later we would have 134.38. That's a 34.38%. It was 3 years. So by doing this, we can now see that the S&P has an average annual gain of 10.38%. So if you were to buy this most popular index ETF available, you'd be averaging about a 10.38%. Now, let's find out if that is riskier or a safer investment than the index trading system. I know a lot of times you've heard the more return you get, the bigger risk you have to take. But is that really true? So let's find out right now using the risk-reward ratio. All right, so as you see now, the S&P will make 10%. That's your expected annual gain per year. And so using the risk-reward ratio of 1-to-2, then the most that you should risk is 5%. And we all know in the S&P 500 will drop 5% at least 2 times every year. But let's take a look and see what it's really done in the last 3 years. All right, what we're looking down here is a day-by-day of the S&P's drawdown. So we can see how much risk is in the S&P. And you can see we're starting 3 years ago on 8/30/2016. We can see the S&P was at 2176.12, and it was down a negative 1%. So now remember, we should never lose more than 5%. So we're already down -1, so we shouldn't see it go further below a -6. If it is, then this is a really risky investment. So let's take a look here. -3, -3, -2, -1, -3, a new low. You see each one is marked a new low. Now it's down -5. So remember, we started at a -1, so we're down -4. And then it made a new high right here, so it has to start over. And we're again looking for a -5% now because we're started with a new high. And so as we move in here, we don't see any. We keep moving. We don't see any. Keep moving. Keep moving. -1, -3, minus something, minus. These are all new highs. Okay, so we got some more new highs, and now we're making new lows. Now look at this, -10%, -11%. We've gone double over that. So extremely risky. We've now had to risk $11 to even get a $10 gain, and that's really not what you want to do to get a 10% average annual return. And so now we're down again another 10, so that's twice now. -10, -13, -4. Now it went down -20. So now we've had to risk $20 of our money to make an annual 10% gain. So and then it's minus 6 again. Now we're back up here making some new highs, and now it's down again, minus 5. So you can see it hit the maximum many times, and it actually went down 4 times as much. We never saw that with the index trading system. All right, so there you just saw in the last 3 years, we saw many 5, 7, even 10, 11% drops, and we even saw one 20% drop. So investors are willing to, risk 20% to win 10%. So there you have it. I showed you how to use the risk-reward ratio to check the feasibility of, investing in the stock market or using an index ETF like SPY. I also showed you how to use it to, to assess the risk reward of an investing newsletter like the index trading system. So now that you've seen that, we can now compare these two investments to each other to see which one is the better investment. And as you see, only one qualifies on the risk reward ratio, and that's the index trading system it did meet the 1-to-2 ratio minimum, whereas the SPY was totally backwards. And you can see that for the SPY or the stock market, you have to invest 20% of your retirement funds to get a 10% annual gain. If you're willing to take a little bit more risk, a 50% more risk, you can get 7 times more your money. So it's just really a no-brainer when you're able to use the risk-reward ratio and be able to compare different investments with each other. It makes things much clearer, and you can make a smarter decision on where you're going to invest your money, because you have to realize we only have a certain amount of time in our life, and you want to get the biggest return possible for the least amount of risk. And the risk-reward ratio will tell you which investments qualify for that. So thank you very much for watching this video, and here's to your success.